Over the last week, the S&P 500 continues to go higher, although we note the majority of this is being driven by the technology and semiconductor space, but we see a lot of red in other industries, healthcare, industrials, energy, which brings us on today's episode of 12 undervalued dividend stocks near 52-week lows. Now we're only looking at those that have a minimum double buy rating, which as we can see for McDonald's is achieved, although Quant does give this a hold. As we said, trading right there towards its 52-week lows, down 15% over the last 12 months. Over the last 10 years, if you have been a shareholder, you would be up around 149%. And as we can see, all-time highs not too long ago, just above $300 in 2024. Forward P at 20.5, it does sit lower than the S&P of around 23, and the forward yield 2.66 is also one of the highest that McDonald's has offered just over the last 5 years. Now, when we take a look at this company, their dividend does look to be safe, a score of 77, and we can also see in their more recent increase, October last year, 9.9%, which is what we like to see, and something that historically McDonald's does offer very high single-digit increases. Now, typically on the channel, we do look at the valuation model, and we run through every single model in depth and do a quick deep dive. Today's episode, we're jumping straight in. The intrinsic value just over $295. With the current price at $250, we like to use an MOS on this channel of around 10%. Remember, we execute on that if it does hit the 3 criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, we'll buy at 266. At 15%, a buy at 250, which is pretty much bang on the current trading price today. So if you are interested at a 15% margin of safety, McDonald's does look to be a buy. For those that look at 20%, well, you would be waiting for around $236. So today you get a 15% MOS level, and we do know Wall Street do indicate 23% upside, $309 price target, which is also higher than our intrinsic value. They believe this is achievable over the next year. We then move on to Vich Properties, where we actually have a triple buy. This is one that is trading towards its 52-week lows. It is also a REIT, real estate investment trust, with a forward yield of just under 6% and a P to FFO just under 11. It is also under the sector PE, and we note over the last 12 months it is down around 12%. Over the last 5 years, however, if you are a shareholder, you would have been up 24%. Bear in mind, these figures don't include reinvestment of dividends, so if you were to have done that, your results would be marginally better. In terms of looking at the dividend, well, it does have a score of 50, so borderline safe. As we have looked in depth, this is essentially driven from the fact that they do have quite a high debt level. The net debt to EBITDA is above the 5 that we do like to see. But one of the things that is very nice with this REIT are those very nice increases to their dividend, 6.4% just last September. It is one of the highest companies in the industry that does offer very nice increases. We then move on to Vich Properties stock analysis, and what we can see is that the value is coming to $38 today, which is significantly higher than the current price. So that does mean the MOS level is very high. 10% will buy up to $34, 15% around $32, 20% around $30, and we can see in today's episode you're getting at least a 25% margin of safety up to around $28.32. On top of that, Wall Street very bullish. We did get a triple buy that does include Quant, who rarely do say buy ratings. They see 23% upside, price target $34 over the next year. We then move on to Pfizer. We're actually very interesting. Quant give this a strong buy. That is a very rare signal with a double buy from the other two analysts. We see it trading in the lower end of the 52-week range with a forward yield similar to Vich Properties, just under 6%, and a forward PE of just under 12. Now, in terms of their performance, battered down 23% over the last 12 months. Over the last 10 years, as you can see, negative 3%, although if you were reinvesting over the period, you'd probably marginally be in the positive, and we can see that downtrend from 2021, where it did peak at around $60. When we talk about this company, it is nice for a company that yields around 6%, that their dividend is safe at 75%. But do note their increase in the more recent period at 2.4% is lower than the inflationary target that we always like to aim for on this channel of around 4% or more. When we look at their valuation, well, intrinsic value just over $32, margin of safety at 10% would indicate a buy at $29. At 15%, you would have to wait, but it isn't that far off, so you could argue right now for PFE, you are getting a 15% MOS level, with Wall Street considering this a buy 20% over the next year, price target just under $34. We then move on to Gilead Sciences, a double buy rating, the hold coming from Quant, trading towards its 52-week lows with a forward yield 4.62% and a forward PE just below 18. Over the last 12 months, well, down 14%. Over the last 10 years, down 25%. It does look like it is going in a downward trend. As you can see, last time it did hit its peak was around 2015 at $120, currently trading pretty much at half that level. When we look at the dividend safety, great to see a safe score of 70. Similar to Pfizer, their increase is lower than inflation. In fact, this was just a few months ago at 2.7%. However, when we do look at the valuation, we do see a nice margin of safety. Our intrinsic value at $88.50 does indicate that a 10% MOS would be a buy at $80, at 20% around $70.80, and that 25% you can see pretty much around that level. So if this is one that you do believe in the long term, we estimate around a 25% MOS level, with Wall Street giving this a nice upside 24%, price target $83. As always though, let us know your thoughts about these companies as we do go through, if you're looking to buy, sell, or maybe on the watch list. We then move on to Medronics, where we get another double buy rating, the hold from Quant, trading in the mid to lower end of the 52-week range with a forward yield 3.61%, forward PE just above 14, and over the last 12 months, not the greatest performance, down 11%. Over the last 10 years, as we can see, it has been on a massive roller coaster where it did peak around August 21 at $135. Again, it is trading around half that in today's market. When we look at their dividend safety, well, very nice to note, 99, the highest score obtainable, very safe, and in fact, this is one of the highest yields they have offered over the last 5 years. But similar to the previous company, just a few months ago, we did get a below inflationary increase to their dividend at 1.4%. When we take a look at the intrinsic value, well, at $100 is what we do estimate the fair value of this company. 10% MOS will buy at $90, at 20% around $80.07, and 25% isn't quite there yet, so we do see a nice 20% margin of safety, whilst Wall Street do indicate 21% upside with a $94 price target over the next 12 months. Now, just to let you know, for those that are subscribed to the newsletter, on Monday we will be releasing all 49 Dividend Kings. We'll be talking about every single one, the ones that we see a lot of upside and that we do consider to be undervalued. If you are subscribed, not only will you get that free Dividend King spreadsheet, but you will also have instant free access to all of these other articles, and we do release one every single Monday as well. So when we take a look at the next one, we have Cisco Systems, a double buy rating, hold from Quant, trading towards the lower end of the 52-week range, yield of 3.43%, forward P around 12.5, and similar again, not the greatest last year, down 9%, and over the last 10 years, it is up around 83, but you would have underperformed the S&P 500, and we can see all-time highs sitting around that $65 mark. In terms of dividend safety, well, another one similar to Medronics, 91, very safe score, but also again, this has been a common theme today so far, a below inflationary increase just in February of this year. However, when we do take a look at the intrinsic value, $61, margin of safety at 10%, well, a buy at 55, at 20%, 48.85, so you are getting at least a 20% margin of safety. 25% isn't too far off, so you could argue right there towards that 25% MOS level based on our estimates and judgments, with Wall Street indicating 70% upside, $55 price target. We then move on to Comcast, again very similar on the rating summary, a double buy rating and a hold from Quant. It is trading right there towards its 52-week lows with a forward yield 3.28%, forward PE just below 9. Over the last 12 months, well, down 9%. Over the last 10 years, as we can see, up only 39%, although we can see again all-time highs around $62 3 years ago. We're on a bit of a roll here with very safe dividend scores. I believe this is the third one in a row now, so that is always a great sign. And we can see something that we haven't seen lately, 6.9% increase this year, again above inflation, which is always a very good sign. In terms of the valuation, well, $51 as our intrinsic value, 10% MOS, a buy at 46, 15% around 44, at 20% around $41, and in today's episode you are getting at least a 25% margin of safety, Wall Street clearly indicating upside of 24%, their price target $47, marginally lower than our intrinsic value. Again, they do believe this is one you should consider for your portfolio. We then move on to Realty Income, well, a triple buy, and again a very rare strong buy from Quant, trading in the mid to lower end of the 52-week range. This company does pay every month those dividends just under 6%, P to FFO just under 13, and also below the sector median. When we take a look at the performance, well, over the last 12 months, down 12%. Over the last 10 years, as we can see, up 22%, hasn't recovered from the all-time highs just before that COVID drop at around $80. In terms of dividend safety, nice to note for a monthly payer at 80, so it is safe. And they have also increased the dividend just over 3% over the last full year, so marginally lower than that essential inflation rate we like to see. Intrinsic value at $64, again, nice margin of safety. 10% a buy at $58, at 20%, not too far off, but it isn't quite there yet. So today for Realty Income, you are getting at least a 15% margin of safety, with Wall Street indicating $60 price tag with 13% implied upside. We then move on to UPS, United Parcel Service, that does seem to be downward trend for a very long time. A double buy rating, a hold from quant, pretty much bang on right there towards its 52-week lows, a forward yield just below 5%, and a forward PE just below 17. In terms of the performance, well, negative 25% over the last year. Over the last 10 years, up around 32%, but it is a little bit away from its all-time highs, sitting around $225 around 2 years ago. When we take a look, dividend safety score 69, as well as the fact the yield is one of the highest, if not the highest, is offered over the last 5 years, but we do have to say a very poor increase just in January this year of 0.6%. When we take a look at the valuation, well, first thing to note, our intrinsic value pretty much in line with Wall Street's price prediction, and we do see a 10% margin of safety, a buy at 146, 15% a buy at 137.90, so pretty much around a 15% margin of safety, with Wall Street again saying 20% implied upside over the next year. We then move on to Starbucks stock, where we do get a double buy and a hold, trading right there towards its 52-week lows, a forward yield bang on at 3%, with a forward P marginally lower than the S&P at 21.24. Over the last year, poor performance from their earnings, negative 23%. Over the last 10 years, up 93%, and some time away from that all-time highs it did see around $128. When we take a look, now their dividend safety score has been downgraded. It is a 60 borderline safe. One thing we do like is historically they have increased those dividends at a very attractive rate. When we look at our intrinsic value, well, we see $100. With the current price, there is a massive margin of safety. 10% a buy at 91, 15% at 86, at 20% around 81, and we can see in today's episode you are pretty much getting a 25% margin of safety, which is very attractive if you do believe this company over the longer term will recover. We do notice Wall Street have downgraded their upside to 18%, their price target now $90. We then move on to the Hershey Company, which has been hammered down due to the rising cocoa prices, although that does look to be slowing down. Double buy rating, although this time it's a buy from quant and a hold from Wall Street, trading at its 52-week lows with a yield of just under 3% and a forward P just over 19. Over the last 12 months, well, down 26%. Over the last 10 years, up 91, but we can see it has been downward trending since last year, where it was at $275. Dividend still looks to be safe, a score of 80, and we do again see the yield which has been offered the highest over the last 5-year period, and just a few months ago a very strong increase to that dividend, sitting double digits at 15%. When we look at the valuation, well, at $208, the margin of safety may not be as much as the others. 10% pretty much a buy at 188. At 15% you would have to wait for 177, so somewhere in between a 10 to 15% level, with Wall Street clearly indicating upside of 11%, $205 price target. But as we saw, whilst quant and seeking alpha see this as a buy, Wall Street do consider this as a hold. We then move on to the final company, AstraZeneca PLC, with a double buy rating, a hold from quant, trading again towards its 52-week lows, with a forward yield 1.72% and a forward P 25.1. Over the last year, marginal downwards performance of -3. Over the last 10 years, up 283, one of the few today that over this period have outperformed the S&P, and we can exactly see all-time highs 450. Nice score, 92 in fact, dividend safety, very safe, and again another double-digit increase last year, September 23, always a great sign. And when we talk about the valuation, we do believe this has a nice intrinsic value in comparison to the current price. 10% MOS at 334, 15% around 316, and in today's episode pretty much around that 20% margin of safety, and we can see clearly Wall Street give that 17% upside $350 price target. As always, let us know your thoughts about these 12 undervalued dividend stocks, whether any of those caught your eye, maybe on the watch list, maybe you've been buying over the last few weeks. And as always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and we'll see you all on the next one.